And on today's show, why use Index Universal Life? Part 2 of this week's series on premium financing using Index Universal Life with premium funding strategist and attorney Robert Strauss. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to INSMARK, Life Specs, and Backroom Technician. Let's get down to business. Welcome to the show, Robert.
Thank you, Steve.
Well, we kind of gave an introduction yesterday. If you missed yesterday's show, I highly recommend that you go back out and watch it in chronology. We kind of laid the baseline or the foundation or cornerstone to this whole premise of premium financing, which is back now under Index Universal Life, but specifically contracts that use arbitrage and fixed interest loans. Did I get it right? All
Absolutely.
right. Well, let's walk through this thing. You know, I always hear this phrase, maxed IUL, or you have equity index UL, which sometimes is a controversial just saying that.
Right.
Max funded. Now, when you say that, what do you mean by that? I know what I mean, but what do you mean by that, Robert?
Well, I mean putting the maximum amount of premium into a policy as quickly as possible without creating a modified endowment contract so that it still qualifies under the definition of life insurance.
Have you used in your patent pending methodologies, have you ever used CAVT, the cash value accumulated test? Does that ever even work in this kind of scenario or not really?
Absolutely.
Oh, it can.
So we often use the cash value accumulation test.
So you either could use the TAMRA guideline annual,
correct,
and or the cash value accumulated test.
Correct.
And do you test them each one to see which one's going to be delivering the better numbers?
We do all the time.
Oh, by the way, you're going right. I love you. You're going right down. I love to try them all to see what the best number is going to be for the client.
Absolutely.
Okay, now when we're talking about this, usually your scenario, like we talked about yesterday, is the client is paying 100% of the interest. Is that correct?
That's correct. So that's one of the areas where we're very different from most other premium financing programs. In many premium financing programs, the client actually dials in how much interest he wants to pay. So typically, he may want to match what he's paying already for life insurance, or perhaps he'll want to have a certain budget, or maybe he doesn't want to pay anything out of pocket, and the rest of the interest is simply accrued into the loan. Whenever we design a premium financing program, we always design it so 100% of the interest is paid by the client each and every year.
I see. Okay. Well, now when you're talking about paying off the bank loan with fixed rate participating loan, in your methodology, we talked about this yesterday, it's the 10th year. At the end of the 10 year, we're rolling it out by a loan.
Correct.
And we're paying the bank off and they're out.
And they're out.
So if we're doing this for indemnification, for estate planning, probate, charitable giving, whatever we're doing, they're relieved of any of their and do we still have to make payments, or is this a self-sustaining now?
No, it's self-sustaining. The goal is to literally take the lender out of lending, and so the purpose is to, at the end of the 10th year, to pay off the bank, have the bank release their assignment against the policy. The policy is the primary form of collateral. At that point in time, the transaction becomes self-financed, hence the term self-financed insurance.
Okay. Now let's walk through some of the basic ideas here, because we know we're going to take tax-free. The secret ingredient. I love this. Hopefully it isn't your secret sauce.
Well, the secret to the whole transaction really is generating arbitrage, as you know. And so there are two sides to arbitrage. There is the policy loan interest rate, and there is the crediting rate of the policy. And in any given year, when you borrow money from the policy at a given policy loan interest rate, that money, because it's a participating policy loan, remains in the contract and continues to be credited based on the crediting strategy. And if the crediting rate exceeds the policy loan interest rate, then there's a positive spread or arbitrage.
So I get to keep that spread as the client. It's
right,
as a policy owner.
Exactly. That spread is working for you in the contract.
Now, during this time when we're in the premium financing, is the total cash value collateralized to the bank?
Correct.
Okay, so that's what we're giving, and if there's any shortfall, they may want something else, right? Some other collateralization?
Correct. So during the first 10 years, as long as there's a bank involved in the transaction, before you get to the point where there is arbitrage, then the bank is going to be using the policy as collateral. But once you get to the point where there's arbitrage, there is no bank. It's self-financed.
So, and what's your point about displaying this specific graph showing Moody's corporate bond history?
If my objective is to create arbitrage, then the goal here is to remove as many moving parts as possible. So if arbitrage is defined as the difference between the crediting rate and the policy loan interest rate. And the only way I'm going to achieve arbitrage is when my crediting rate exceeds my policy loan interest rate, and my policy loan interest rate is moving up and down as most policy loan interest rates do, because most policy loan interest rates that are participating are variable rates, then I'm shooting at a moving target. It's going to be very difficult for me to know that in any given year whether or not I can achieve arbitrage. But if my policy loan interest rate is guaranteed fixed for the life of the contract, I've removed one of those variables. I know I'm going to achieve arbitrage whenever my crediting rate exceeds this threshold, which in this case is simply 5%.
We come back from the break, we're going to continue walking through the mortality mechanics of using indices in a policy like Index Universal Life and the arbitrage of participating loans. We'll be right back. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with funding strategist Robert Strauss. We're talking about Index Universal Life and the mechanics of it so that you can understand why we can use this in premium financing. Let's walk through a basic point-to-point indexed scenario, because I think it's great to always redux some basic ideas so we can understand the underpinnings of your philosophy. So let's do annual. It's 100% participation. We're showing an example of a carrier. It's 15% cap. I love that. Zero floor, of course. Now, when we're talking about 100% participation, we're not talking about dividends of the S&P. We're just talking about the return, not dividends, just to clarify.
Correct.
Now, let's talk about an annual point-to-point. Which one do you actually prefer? One that has this scenario versus another one, an asset fee? Do you have any reasons why you would go one way or the other?
Not necessarily, but the goal really is to have two things. Number one, you want a floor of at least zero, obviously, which they all are, 0 or 1%. But you also want to choose one that has a high cap or no cap at all. Remember, our purpose, our goal is to capture arbitrage. It's a little bit different than the goal of other strategies that use equity index UL. So our goal is specifically to capture arbitrage. So we want that crediting rate to exceed our 5% policy loan interest rate. We don't need to have a very stable crediting rate that achieves a certain crediting rate every single year. We don't mind the volatility. In fact, I prefer to have a very high crediting rate sometimes, even if it means hitting my floor of 0 the next year. I don't mind the volatility. I like capturing that high amount of arbitrage occasionally, because when I hit those highs, it adds more to my cash value than I lose when it hits those lows.
Okay, so so even though there might be a volatile swing,
correct,
a 19% cap could make up for a 0 crediting year.
It could. It could. So sometimes it's worth
timeline.
Correct. Sometimes it's worth the asset fee. I mean, those numbers we have to calculate, and we have to look at the history, and we have to, look at the statistics. But usually, I'm looking at an annual point-to-point with a high cap or an uncapped strategy.
Now, I notice you have kind of a blended index here.
That's correct.
Walk me through the theology behind using a blended index versus, say, just the S&P 500 itself.
Well, in order to get a high cap, sometimes you have to look at a blended index rather than a single index. And the reason for that is blended index generally have less volatility, simply because they're a blend of different strategies, and there's a natural hedge when you start blending strategies, blending indexes together. The less volatility, the less the cost of options, and that translates into generally a higher cap or a higher participation rate.
Okay, now here's a historical probability of 6.9. I've noticed in a lot of your proposals, this is kind of the number we're trying to hang around, which I think is actually in the big scope of things of the S&P 500, as an example, maybe not in the blended so much, but the S&P, that seems to be reasonable.
I think it is reasonable, and it works at even lower crediting rates than this as well.
Well, walk me through the mechanics of why this works, why you're showing this slide.
Well, one of the nice things about this program is because we've eliminated so many of the moving parts. For example, we already know going into the transaction what the policy loan interest rate is going to be for the life of the contract, and we know that the lender is going to be gone in 10 years. We can now focus on the crediting rate, and we can determine exactly what the probability is going to be of achieving any crediting rate. So I can plug in a hypothetical crediting rate. In this case, I chose 6.9%, but the client can choose a different rate. The client can choose 6.5 or 7 or whatever crediting rate the client decides to choose, and figure out by looking at rolling periods of time what the historical probability is of achieving that. You can see that in this case, if we look at rolling 15-year periods of time, the historical probability of achieving 6.9% is 88.9%, and the shorter the period of time, the less the probability is. But again, this is a long-term strategy. But in terms of suitability, the client can determine whether or not he's comfortable with these levels.
Can I extrapolate from that just to make sure? This is a kind of a question off our script, but if I go to the 10-year rate, because remember, we're paying the bank back at 10 years, correct? Aren't we paying? Okay, so if 72% of the time, I could have 3 bad years in that 10-year period, right, and still hit my 6.9.
Correct.
See, I think this is the philosophy I want to make sure we get so people understand what we're actually talking about here.
Correct, and even if you did, it's important to look at lower crediting rates to see what effect that might have on the contract.
And you can display that, of course, by showing different rates. I love your thing about your saying, well, I have a 10-year fixed loan. I have a fixed interest rate. I'm trying to arbitrage my in this case, 5% versus anything above the line to pick this off. In this case, this is 6.9. It sounds like it doesn't take much to make this arbitrage work.
Correct.
All right, walk us through this.
This is another example, just a different crediting strategy. And many times I hear people say, well, all crediting strategies should be illustrated at this crediting rate or that crediting rate. And I find that different crediting strategies really yield different statistics, different numbers, different probabilities of success. So it really does matter which product you use and which crediting strategy you use. So for example, in this case, we're going to look at an uncapped strategy. In this case here, the company is going to be hedging between the S&P 500 and the U.S. Aggregate Bond Index and reallocating their portfolio on a daily basis based on the volatility. So the more volatile the S&P, the more they're going to put into bonds and vice versa. Okay, so let's look at the next slide, and you can see what the probabilities, what happens to the probabilities with this uncapped strategy is that they actually go up significantly. So even though it's the same crediting rate that I'm illustrating, the probabilities increase over rolling 15-year periods from 88.9% to 97%, and then over the 10-year periods from 72 to 79%. So the point that I'm making here is that not all strategies necessarily are going to yield the same probability. So it's very important to shop around.
Oh, I like this because really you're giving a reason now to shop the index. Most people are just putting down the S&P 500. 72% of all index annuities and index life are choosing the S&P.
Exactly.
In this situation, we haven't changed our probability, historical probability rate, but we have given ourselves a chance to make the probability numbers go up. Exactly. And I love that. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.